Good day, everyone. I am Valerie Joyce Mendez Kalinga, and today I'll be discussing about understanding federal income tax principles. This lesson focuses on understanding the basic principles of federal income tax and why it is important in everyday life. Taxes are mandatory payments collected by the government to fund essential public services such as education, healthcare, infrastructure, public safety, and national defense. Since federal income tax is often one of the largest taxes individuals pay, understanding how it works helps people become more financially responsible and aware of their obligations as taxpayers. Another important concept in this learning goal is tax planning, which involves legally organizing finances to reduce tax liability while complying with tax laws. By understanding taxable income, deductions, tax credits, and exemptions, individuals can make better financial decisions and avoid unnecessary tax burdens. In addition to federal income tax, people may also pay state, local, sales, and property taxes, depending on where they live, making it important to understand how different types of taxes contribute to government services and economic development. Next is the economics of income taxes. The federal government mainly relies on income taxes as its primary source of revenue to finance essential public services and government operations. These funds support programs such as education, healthcare, national defense, infrastructure, social security, and other public services that benefit millions of people. Because income taxes play a vital role in funding these programs, understanding how the tax system works is an important part of financial literacy and responsible citizenship. The United States uses a progressive tax system, which means that tax rates increase as a person's taxable income rises. However, this does not mean that all of a person's income is taxed at the highest rate they qualify for. Instead, only the portion of income that falls within each tax bracket is taxed at that specific rate, while the lower portions are taxed at a lower rate. As a result, a taxpayer's average tax rate is generally lower than their highest marginal tax rate. This system is designed to distribute the tax burden more fairly, allowing those with higher incomes to contribute a larger share while ensuring that lower income earners pay lower tax rates. Next is your filing status. A taxpayer's filing status is one of the most important factors in determining how much income tax they owe. It is based on a person's marital status and family situation as of the last day of tax year. The 5 filing statuses are single, married filing jointly, married filing separately, head of household, and qualifying widow or widower with a dependent child. Each filing status has its own tax rules and requirements, so taxpayers must choose the one that best matches their circumstances. Selecting the correct filing status is important because it affects tax rates, the amount of the standard deduction, and eligibility for various tax credits and deductions. For example, some filing statuses provide lower tax rates or larger deductions, which can reduce the amount of tax owed. On the other hand, choosing the wrong filing status may result in paying more taxes than necessary or even facing penalties. Understanding the different filing statuses helps taxpayers file accurate tax returns, maximize available tax benefits, and comply with tax laws. The last one is the take-home pay and withholding taxes. Most employees pay their taxes through a pay-as-you-go system, which means taxes are collected gradually throughout the year instead of being paid all at once. Every time an employee receives a paycheck, the employer automatically deducts certain taxes before the salary is given. This process is called tax withholding. The amount withheld depends on factors such as the employee's income, filing status, and the information they provide on their tax forms. As a result, the employee's take-home pay is the amount left after these required deductions have been made. The taxes withheld from each paycheck typically include federal income tax and FICA taxes. FICA stands for the Federal Insurance Contributions Act, a U.S. law that requires both employees and employers to contribute to Social Security and Medicare through payroll taxes. These programs provide retirement income, disability benefits, survivor benefits, and health insurance for eligible individuals. At the end of the tax year, employees file an income tax return to compare the taxes already withheld from their paychecks with the amount they actually owe. If too much tax was withheld, they receive a tax refund. If too little was withheld, they must pay the remaining balance to the government. Thank you for listening. I hope you learned something new about the principles of federal income tax and now have a better understanding of how taxes are calculated, withheld, and used to support public services. Good day, everyone. I am Valerie Joyce Mendez Kalinga, and today I'll be discussing LG2. It's taxable income that matters. This lesson explains that taxable income, not gross income, is the basis for determining how much federal income tax a person owes. Gross income includes all sources of earnings such as salaries, wages, bonuses, interest, and other income. However, not all of this income is subject to tax. Before taxes are calculated, taxpayers may qualify for adjustments, deductions, and exemptions that reduce their taxable income. These reductions lower the amount of income that is actually taxed. As a result, the lower the taxable income, the lower the tax liability may be. This is why understanding taxable income is important, as it helps taxpayers legally reduce the amount of tax they owe while ensuring they comply with tax laws. Next is the gross income. Gross income refers to the total income an individual earns from all sources before any taxes, deductions, or exemptions are applied. It serves as the starting point for determining taxable income. Gross income includes wages and salaries earned from employment, bonuses, and commissions received as additional compensation, interest earned from bank accounts or investments, and dividends from stocks. It also includes income from operating a business, rental income earned from leasing property, capital gains from selling assets such as stocks or real estate at a profit, and pension income received during retirement. By adding all these sources together, we can get the total gross income, which is then adjusted through deductions and other allowable reductions to determine the amount of income that is subject to taxation. Next is the three types of income. Income can generally be divided into three basic types: the active income, portfolio income, and passive income. Understanding these categories is important because they are often treated differently under tax laws and financial planning. The first type is active income. This is the income a person earns by actively working. Examples include salaries, wages, overtime pay, commissions, bonuses, and professional fees. For most employees, active income is their primary source of earnings because it requires continuous effort, time, and labor. The second type is portfolio income. This income is generated from investments rather than from performing work. Common examples are dividends from stocks, interest earned from savings accounts or bonds, and gains from selling investments. The money works for the investor, and the return depends on the performance of the investment. The last one is passive income. Passive income comes from business or investment activities in which the owner is not materially or actively involved on a day-to-day basis. Examples include rental income from properties, earnings from limited partnership, royalties, or income from certain automated businesses. Although some initial effort or capital is usually required, passive income can continue to generate earnings even when the owner is not actively working every day. These three types of income are important because tax rules may apply differently to each one. Governments often have separate rules for wages, investment earnings, and passive activities when determining taxable income, deductions, losses, and reporting requirements. Next is the steps in computing taxable income. The process of computing taxable income involves several important steps. First, determine the gross income, which includes all taxable earnings received during the year, such as salaries, wages, business income, and investment income. Next, subtract any allowable adjustments to arrive at the adjusted gross income, or AGI. These adjustments may include certain qualified expenses that reduce income before deductions are applied. After calculating the AGI, subtract any eligible deductions and exemptions, if applicable under the tax laws, to determine the taxable income. Taxable income is the amount that will be used to calculate how much tax a person owes. Finally, apply the appropriate tax rates to the taxable income to compute the tax liability, which is the total amount of income tax that must be paid to the government. Standard or itemized deductions. After computing the adjusted gross income, or AGI, taxpayers can further reduce their taxable income by claiming deductions. There are two methods to choose from: the standard deduction and itemized deduction. The standard deduction is a fixed amount determined by the taxpayer's filing status, such as single or married, filing jointly. Since it does not require listing individual expenses, it is simpler and faster to claim, making it the option most taxpayers choose. The second method is itemized deductions, where taxpayers list their actual qualified deductible expenses instead of taking the fixed amount. These expenses may include medical and dental costs, charitable contributions, mortgage interest, and certain state and local taxes paid. However, taxpayers generally choose itemized deductions only when the total of these expenses is greater than the standard deduction. In the end, taxpayers select whichever deduction method lowers their taxable income the most, helping reduce the amount of income tax they owe. The last one is exemptions. Exemptions are another important factor in reducing taxable income. They allow taxpayers to subtract a certain amount from their income based on their eligibility, which helps decrease the income that is subject to tax. In many tax systems, taxpayers may claim exemptions for themselves and for qualified dependents, such as children or another eligible family members, as long as they meet the legal requirements. The purpose of exemptions is to recognize the financial responsibility of supporting oneself and dependents. Since exemptions reduce taxable income, they also reduce the amount of tax that must be paid. As a result, eligible taxpayers can lower their tax liability and keep more on their income for their personal and family needs. In summary, taxes are essential because they fund government services. Income tax uses a progressive system where higher incomes generally pay higher tax rates. A taxpayer's filing status, adjustments, deductions, and exemptions all affect the final amount of taxable income and taxes owed. Understanding these concepts helps individuals plan their finances wisely while complying with tax laws.
Good day everyone, my name is Rochelle Picon that today we are diving into Chapter 3 of Financial Planning, which focuses on one of the most critical aspects of personal finance, calculating and filing your income taxes. While taxes can often lead or feel overwhelming due to complex jargon and endless forms of numbers, our goal today is to break down the process into clear, manageable steps. We will examine how tax rates and tax brackets operate, contrast tax deduction with tax credits, learn how to select the correct IRS form, and walk through two real-world case studies, from a simple single filer return to a comprehensive family tax calculation. Let's get started. Tax rates and marginal tax brackets. Para masabtan nato kung pila jud ang atong bayranan sa tax, kinahanglan una nato ma-understand kining three core concepts. The first is progress tax structure. Ang atong tax liability kay calculate based sa atong reported tax income gamit ang progressive rate system. Meaning, habang mas taas ang imong income, mas taas po ng percentage rate na i-apply. Pagsugod sa 10% hangtod 35%. Based sa IRS tax schedule. The second is marginal versus average tax rate. Very important nga ma-understand nato ang difference sa duwa. Ang marginal tax rate kay ang tax rate na imong bayaran sa very next dollar na imong ma-earn. Ipakita niini kung usa ang bracket nahulog na highest dollar of income nimo. Ang average tax rate naman kay ang total tax liability divided by total taxable income. Mas ubos jud kini constantly kaysa marginal rate kay ang early portions sa imong income kay i-enjoy sa mas ubos nga rates. The third is alternative minimum tax, kundi kaya AMT. Kidesign kini nga parallel tax system para masiguro nga ang high income earners na may dagdag na deduction kay magbayad gihapon og baseline minimum tax around 26% to 28%. The next is 2008 tax rate schedules. Para mas mag-visualize nato kung giunsa pag-compute, tanawan ninyo kining 2008 tax rate schedules. Dahil nato makita ang pag-apply sa brackets based sa imong filing status, katulad sa single or married filing jointly. Like for example, tanaw nato ang usa ka single filer na may taxable income nga $35,600. Ang iyang first is 8,025. Kay i-tax og 10%, may mo siya $802.50. Ang sunod nga portion kay or gikan 8,200 hangtod 32,550. Kay i-tax og 15%, ang remaining kay 3,050 above 32,550. Kay mahulog na sa iyang 25% marginal bracket. If i-add na to ang base tax na $4,481.25 plus 25% sa 3,050, ang total tax liability kay $5,244. Kung katong i-divide sa iyang 35,600 income, ang iyang average tax rate kay 14.7%. Para mas ubos kaayo compared sa iyahang 25% marginal bracket. Tax credits versus tax deductions. Kung magani kay usa ka golden rule na timaan kang adlaw, memorize. Mas valuable o dako og savings ang tax credits kaysa sa tax deductions. Tanawon nato kung ang tax deduction kay nagpaubos sa imuhang taxable income. Kung nagka sa 25% tax bracket, ang $1,000 nga deduction kay mahatag ra nimo og $250 nga actual tax savings. At ang tax credit kay naghahatag og dollar for dollar reduction sa imong mismong final tax bill. Ang $1,000 nga tax credit kay mag-minus jud og solid nga $1,000 gikan sa imong bayro nun. Pipila sa mga popular tax credits na pwede nimong i-claim or ma-claim ay ang Child Dependent Care Credit or Adoption Tax Credit na moabot up to $11,650. Qualified Electrical or Electric Vehicle Credit ug ang Earned Income Credit, which is IC. Selecting the right IRS tax form. There are 3 tag cards presenting Form 1040EC, 1040A, and Form 1040. Nigabot sa tax filing ang pagpili sa saktong IRS form, ang crucial ni mga first step na naitulo ka main options depende sa pagka-complex ng financial situation. Ang una kay Form 1040EC. Ang simplest form para kini sa single o joint filers na below 65 years old, walang dependents o adunay taxable income na ubos sa $100,000. Ang source sa income kay limited lang sa wages, salaries, o minimal taxable interest, which is below $1,500. And the next is Form 1040A. It is short term, para gyapon sa income below $100,000. Dili pwede makaklaim og tax payers of traditional IRA deductions, education tax credits, o dependent exemptions without needing to itemize the Schedule A. The third is Form 1040. It is a standard comprehensive form. O kini ang full return. Required ni siya gamitin kung ang income mo lapas og $100,000 kung ang mag-itemize ka og deduction sa Schedule A o kung may self-employment income or Schedule C o capital gain. Sample return in the Form 1040EC. We'll be diving into Akira Takayama case. Ato tanawon kining sample return gamit ang Form 1040EC para sa usa ka full-time student o part-time employee nga si Akira Takayama. Pagsugod si Akira sa iyang $23,500 sa wages, salaries, o tips, plus $50 na taxable interest income, giving an adjusted gross income, which is AGI, na $23,600. Next, isubtract na to ang standard deduction o personal exemption na $8,950. Ang mabilin nga taxable income kay $14,650. Based sa IRS tax tables, ang total calculated tax due ni Akira kay $1,843. Tanaw na to ang iyang withholding sa paycheck. 475 lang ang naimbayad sa whole year. Mas nako man ang iyang tax liability kaysa na withhold. Si Akira kay naay balance is $1,368. And the next is case study about Thomas and Emily Tribble in relation to gross income to AGI. Karon atong i-examine ang mas detailed na family case nila Thomas ug Emily Tribble. Married sila, filing jointly, may tulog anak. Atong sugdan ang steps sa pag-compute sa ilang adjusted gross income versus AGI. Gross income sources in the total of 78,015. First is active income. Si Thomas may salary nga 60,415. Sa Emily na ay 9,750. O si Thomas nakakuha pud og 5,800 net profit gikan sa iyang side business sa Schedule C. Total active income nila is 75,965. The next is portfolio income. Nag-earn po sila og 800 sa interest o 1,200 sa capital gains, adding 2,050. If we total nato ang total gross income sa kay 78,015. Adjustments to gross income na contribute sa Emily sa traditional RIA. So makakuha siya og 4,000 nga full deduction. Nagdeduct ko si Thomas og 443.70 nga maong 50% sa iyang self-employment tax. If i-subtract nato kining 4,443.70 na adjustments gikan sa gross income, makakuha nato yung ilahang adjusted gross income AGI nga 73,571.30. Itemized deduction versus personal exemption. After pag-compute sa AGI, kinahanglan mag-decide ang Tribble family if mag-standard deduction ba sila o mag-itemize sila expenses sa Schedule A. Let's take a look at their actual itemized expenses. The first is state income and property taxes, which is 2,560. The second is mortgage interest, 7,893. The third is charitable contributions, which is 475. Job expenses is 1,050.57. Total itemized deduction is $11,978.57. Strategic decisions since 11,978.57 ay mas nako kaysa 10,900 standard deduction. Mas nakatipid sila og extra 1,078.57 by itemizing. Nuwagan pa kini sa ilang personal exemptions para sa 5 family members of 2 parent, 3 kids at 3,500 each, which is total of 17,500. Tax liability and tax credits applied. Dili na mag-combine ang tanang computations para sa Tribble family. Pagsugod kita sa ilang AGI nga 73,571.30. Tapos subtract nato ang itemized deduction, which is 11,978.57 of personal exemption, which is 17,500. Ang total deduction of 29,478.57. This leaves us a taxable income of 44,092.73. Using their 15% marginal bracket, ang base calculated tax is 5,811.26. Now, i-apply na to ang child tax credit nga 1,000 per child para sa ilang tulong anak, which subtracts 3,000 directly from the tax bill. Then, i-add na to ang self-employment tax ni Thomas nga 887.40. The final result is their total final tax liability of 3,698.66. Today's presentation always keep a few essential tax filing guidelines in mind. Be sure to file on time by April 15, even if you cannot pay immediately, because filing late occurs far heavier penalties than paying late. Make sure your return is signed properly to prevent severe processing delays with the IRS, and choose direct deposit so your refund arrives weeks faster than waiting for a paper check. Finally, double check that all allowed credits and tax-free deductions are fully accounted for before submitting your return. And that's all. Thank you.
Good day, everyone. I'm Lara Precious Timano, and today I'll be presenting learning goals 4 and 5 of Chapter 3, Preparing Your Taxes, specifically other filing considerations and getting help with your taxes. Let's begin with estimated taxes. Normally, when you're employed, your employer automatically withholds taxes from your paycheck and sends them to the IRS, but that system only works for employment income or the wages and salaries. If you earn money from other sources, say you're an investor, a consultant, a lawyer, or you run your own business, that income is not automatically withheld. That's where estimated taxes come in. The IRS requires people with this kind of income to pay taxes on it themselves in advance using Form 1040 ES, which is normally filed along with your tax return. So these payments are not paid at once. They are split into four installments: April 15, June 15, and September 15 of the current year, and January 15 of the following year. One important note: if you fail to estimate and pay these taxes correctly, the IRS can charge you penalty. So this is not optional. It's a required part of tax compliance for anyone earning non-withheld income. Next, let's talk about deadlines. The US tax year follows the calendar year, which is January 1 to December 31. And the golden rule everyone remember is your return is due no later than April 15 of the following year or the next business day if the 15th falls on a weekend or holiday. Nowadays, filing is easier than ever. You can file and pay electronically through e-file and e-pay, either by credit card through an authorized e-file provider, which does charge a small fee, or by authorizing direct electronic withdrawal from your bank account. But what if you're not ready by April 15? That's where a filing extension comes in. You can get an automatic 6-month extension, pushing your deadline to October 15, simply by submitting Form 4868. But here's the part students often get wrong. So I want to highlight it clearly. An extension only gives you more time to file, not more time to pay. If you owe taxes, you still need to estimate that amount and pay it by April 15, or you will face penalties and interest on the unpaid balance. Sometimes, after you have already filed your return, you realize you made a mistake. Maybe you forgot to report some income, or you missed a deduction you were entitled to. For situations like this, the IRS allows you to file an amended return using Form 1040X. This form lets you correct the amount of income or deduction you originally reported, and it recalculates whether you're owed a refund or whether you actually owe more in taxes. Example: imagine a taxpayer computed and paid $2,450 in taxes using the standard deduction. A few months later, they realized that if they had itemized their deductions instead, their tax bill would have only been $1,950. By filing an amended return, they can claim a refund of the difference. That's $500. Now, how much time do you have to file an amended return? The rule is whichever is later, 3 years from the date you filed your original return or 2 years from the date you paid the tax. To avoid needing to amend in the first place, it's smart to calculate your taxes using both the standard deduction and the itemized deduction methods before you file, and simply choose whichever gives you the lower tax liability. Now, let's move to a topic that makes a lot of taxpayers nervous: audits. A tax audit is simply an examination conducted by the IRS to verify that your return is accurate. Why does the IRS need to do this? Because taxpayers themselves provide all the information and fill out their own forms. The IRS has no independent proof that everything was calculated correctly. So, in addition to targeting returns that stand out for some reason, the IRS also randomly selects some returns for review. What exactly do auditors look at? Mainly two things. First, whether all income received was properly reported, and second, whether the deductions claimed are legitimate and in the correct amount. Now, here's some reassuring news. The odds of actually being audited are quite low. Fewer 2% of all returns get audited, though higher income earners do face a somewhat greater chance. And audits are not always bad news for the taxpayer. In fact, about 5% of audits result in a refund back to the taxpayer, and 15 15% simply confirm that return was correctly prepared in the first place. One less important point: the IRS can go back and audit a return for up to 3 years and in some cases up to 6 years from the date it was filed. That's why the book recommends keeping your records and receipts for about 7 years. And remember, violating tax laws is not a small matter. It can lead to severe financial penalties and, in extreme cases, even prison sentences. So, what actually increases your chances of being audited? 9 common red flags. Number one, unusual increase in income. Number two, income that is not properly documented. Number three, income that's lower than what's reported on your Form 1099. Number four, returns that are missing signatures, social security numbers, or required forms. Number five, math errors. Number six, owning a small business, because filing a Schedule C raises your audit chances. And number seven, itemized deduction that are much higher than the average for your income bracket. And number eight, taking the home office deduction. And lastly, number nine, casualty losses. Some of these triggers are simply unavoidable depending on your situation, but you can reduce your risk by making sure your numbers add up correctly, including all required forms and information, and something people surprisingly forget: actually signing your return. Before we move to LG5, let's go through 7 practical tips, the financial road sign meant to help you avoid common tax filing hassles. Number 1, file on time, even if you can't pay the full amount you owe, because filing late and paying late are penalized differently, so at least get the form in. Number 2, don't overlook tax-free income. Things like an inheritance, tuition, scholarships, and gifts of money, which back in 28 were limited to $12,000 per year from any one person. And number 3, don't forget to actually sign your return even if you're filing online. Number 4, use direct deposit because it gets your refund to you faster. 5. If you can pay your whole tax bill at once, you can pay in installments by filing Form 9465. Number 6. Even if you get filing extension, pay what you estimate you will owe anyway. Remember, the extension does not extend your payment deadline. And 7. If you're donating non-cash items to charity worth more than $500, make sure to include the receipts along with Form 8283. Now let's move into LG5, getting help with your taxes. The first source of help, and it's completely free, is the IRS itself. The IRS publishes free materials with step-by-step instructions to guide you through preparing your return. You can order this by mail, download them from www.irs.gov, or request them by phone. The most comprehensive one is the Publication 17, Your Federal Income Tax, or a free through reference guide. There are also Teletax, which provides recorded phone messages on specific tax topics, and Faxback, a service that will fax you forms and instructions on request. But here's something many people don't realize. The IRS will actually compute your taxes for you, completely free, if two conditions are met. Your taxable income is under $100,000 and you don't itemize your deduction. If you qualify, you simply fill in your data, sign and date the return, and mail it in by April 15. The IRS calculates that they call the smallest tax bite and then either sends you a refund or a bill. And even you don't qualify for this specific service, toll-free phone assistance is still available to help you prepare your return. Now, more than half of all taxpayers actually prefer to hire a professional to prepare their taxes. Categorizes these preparers into four main types. First, national and local tax services, which this includes big national chains like H&R Block, as well as independent local firms. These are best suited for taxpayers with fairly common, straightforward types of income and expenses. Second, certified public accountants, or the CPAs. These are tax professionals who not only prepare your return but can also advise you on broader tax planning strategies. Third, enrolled agents, or EAs. These are federal licensed practitioners who have passed a difficult 2-day IRS administered exam. They are fully qualified to handle tax preparation at any level of complexity. And finally, the tax attorneys, lawyers who specialize specifically in tax planning, typically for more legally complex situations. Money in Action gives a slightly different, more practical breakdown of preparers types, organized by who they are best suited for. First, non-licensed preparers are best for straightforward returns. They have minimal training, but they operate year-round and are usually the least expensive options. Next, the CPAs. CPAs are ideal if you want ongoing tax advice. They can suggest broader tax saving strategies beyond just filing out your form. Next, the enrolled agents, or the EAs, are a great option for individual tax advice, and worth noting their fees are typically about 1 year, one third lower than CPA fees, even though they are just as federally licensed. Last and last but Tax attorneys. Tax attorneys are best reserved for complex, legally risky situations. For example, the complicated sale of a small business not having filed taxes in previous years or estate and trust issues. In terms of cost, typically preparer fees range from about $150 to $450, though the overall range can go from as low as $100 for a very simple return up to $1,000 or more for a complicated one. One thing I want to emphasize here, you are legally responsible for your own tax return, even if someone else prepared it for you. So a good preparer is not just someone who fills out the form. They should guarantee the accuracy of their work, be willing to amend any mistakes they made, and be willing to assist you if you are ever audited. Now, I want to be honest with you. Hiring a professional does not guarantee a perfect return. In fact, a Money Magazine test once contacted 45 experienced tax preparers to prepare the same fictional family's return. Not one of them got it exactly correct, and only 24% even came within $1,000 of the correct tax liability. That's why the IRS requires preparers to sign every return they prepare, include their social security number and address, and give the taxpayer a copy of what was filed. It creates accountability. So, what can you do to reduce your own risk of error? First, decide exactly why you need a preparer. Is it for speed, accuracy, general strategy advice, or help with the complex situations? That helps you choose the right type. Second, ask for referrals from your lawyer, financial planner, or friends, and make sure you genuinely feel comfortable sharing your financial records with them. Third, take time to become familiar with basic tax principles and regulations yourself. Fourth, always check documents like your W-2S and 1099S for accuracy. Fifth, maintain good communication with your preparer and don't hesitate to ask for an explanation of anything you do not understand. And finally, always, always check your complete return carefully before signing it. Remember, you remain primarily responsible for its accuracy, not your preparer. Our last topic under LG5 is computer-based tax preparation for those who prefer to do it themselves using software. There are really two categories of tax software. The first is tax planning software like Weekend, which lets you experiment with different financial strategies to see how they affect the amount of tax you owe. The second is tax preparation software, which helps you actually complete and file your return, taking much of the work out of the process and cutting your preparation time from days down to just a few hours. The two major players in this space are TurboTax and Block Financial Software's Tax Cut. Yan siya kanina. Both available for Windows or Mac, with TurboTax even offering a web-based version. This software is based this software is best suited for taxpayers who itemize their deduction but don't need professional tax advice. If your return is simple, like 1040EZ, you don't really need software at all. And if your return is complex, there's still no substitute for the expertise of a real tax professionals. For those who prefer a free option, the IRS also offers what are called fill-in forms. These let you type your information directly into the form using Adobe Acrobat Reader, giving you a cleaner printout than filing it out by hand. But keep in mind, unlike tax software, these forms have um, no computational capability. You have to do all your own math, and Acrobat Reader does not save your progress, so you need to complete everything in one sitting. To wrap up our discussion, under LG4, we learned that estimated taxes must be paid quarterly if your income is not subject to withholding. That April 15 is the standard filing deadline, though a 6-month extension is available through Form 4868. That mistakes can be corrected through an amended return using Form 1040X. And that while audits are rare, affecting fewer than 2% of returns. Keeping accurate records for about 7 years is still essential. So under LG5 to professional preparers, ranging from non-licensed preparers to CPAs, enrolled agents, and tax attorneys, to tax software like TurboTax and TaxCut for those who prefer to file on their own. But no matter which option you choose, the responsibility for an accurate returns always comes back to you, the taxpayer. Thank you so much for listening. I'm Lara Precious Timaano, and I'm happy to take any questions.
Good morning, everyone. My name is Liza Miti de Lagos, and I'll be the last reporter for Chapter 3. Today, I'll discuss the effective tax planning. So before we begin, let me first explain what tax planning means. So it is the process of organizing your income, expenses, and investments so you can legally reduce the amount of tax you need to pay. The keyword here is legally. So the purpose of tax planning is not to avoid paying taxes completely. Instead, it helps you keep more of your money by using the benefits and deductions allowed by the government. For example, if there are tax deductions or tax saving investments that the law allows, you can use them to reduce your tax bill. This helps improve your financial situation while still following the law. Tax avoidance versus tax evasion. Now, let's talk about the most important topic, tax avoidance and tax evasion. Many people confuse these two terms, but they are very different. First is tax avoidance. Tax avoidance is legal, so it means using the tax rules in the correct way to reduce the amount of tax you pay. For example, if the government allows you to deduct educational expenses or retirement contribution, claiming those deductions is tax avoidance, you are simply using the benefits that the law provides. Now let's look at tax evasion. Tax evasion is illegal. This happens when someone intentionally hides income, lies on tax forms, or claims deductions that are not true just to pay less tax. For example, imagine a business owner earned 100,000 pesos but reports only 500,000 to the government. That is tax evasion because they are hiding part of their income. Tax evasion is a crime and can lead to large fines or even imprisonment. So the easiest way to remember this is Tax avoidance is legal and smart. Tax evasion is illegal and punishable by the law. Always remember that effective tax planning is about avoiding tax legally, never evading taxes. Next are some common tax saving strategies. The first is Series TE bonds. These are government savings bonds where the interest is not taxed immediately. Instead, the tax is delayed until you redeem or cash in the bond. This means your money has more time to grow before you pay taxes. The second strategy is called bunching deduction. Instead of spreading your deductible expenses over several years, you group them into one year. Why? Because having more deductions in one year may allow you to claim a bigger tax deduction, which lower your taxable income. The third strategy is shifting income across years. For example, if you expected your income to be lower next year, you can delay receiving some income until next year. Since you earn less next year, you may also pay less tax. This strategy helps reduce taxes while staying with the law. Now let's discuss maximizing deduction. A tax deduction reduces the amount of your income that is subject to tax. The more deduction legally qualify for the lower taxable income, for example, your taxable income is 500,000 and you qualify for 50,000 in deduction, you will only pay tax on 450. This is why deductions are important. PowerPoint also mentioned grouping deduction, paying certain expenses before the end of the year, combining medical expenses, and making charitable donation. These are all legally ways to increase deduction or reduce taxes. The main lesson here is to always keep records of your experiences because they may qualify for deduction. The next topic is income shifting. Income shifting means transferring income or income producing assets to a family member who belongs to a lower tax bracket. For example, parents may give investments that earn interest to an older child. Since the child has a lower income, the tax on the interest may also be low. As a result, the family pays less tax overall. However, this strategy has limitations. The government has rules such as the kiddie tax to prevent people from abusing this strategy. If my, it may also affect the child financial aid eligibility for college. So while income shifting can save taxes, it should always follow government rules. Next is income timing, which explains the difference between tax-free income and tax-deferred income. These two terms may sound similar, but they are different. Tax freedom means you never pay tax on that income. An example is interest earned from municipal bonds. No tax is collected on that income. Meanwhile, tax-deferred income means you do not pay taxes now. Instead, you pay them later, usually when you withdraw the money. A common example is a retirement account like a traditional IRA. The advantage of tax-deferred income is that your money continues growing before taxes are deducted. expected. To summarize our lesson, effective tax planning is about making smart financial decisions that help us reduce taxes legally. We learned that tax avoidance is legal while tax evasion is illegal. We also learned different ways to reduce taxes, such as maximizing deductions, using tax-saving investments, shifting income when allowed, and understand the difference between tax-free and tax-deferred income. The biggest lesson is that tax planning should not only happen during tax season. It should be part of our overall financial planning because good tax planning help us more money build with build wealth and achieve. It should be part of our overall financial planning because good tax planning help us save money, build wealth, and achieve our financial goals while following the law. Thank you everyone for listening. That's the end of my presentation.